Welcome, everyone. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to us or sponsored by Stock Traders Daily. We're very pleased to have Thomas Key Jr., who's the president and CEO of Stock Traders Daily, with us to deliver today's presentation. So with that, please join me in welcoming Tom Key. And Tom, I'm going to go ahead and pass you the presenter controls. So if you share your desktop, we'll go ahead and get underway here this afternoon. Thanks for joining us, Tom.
Thank you very much, Cynthia. I appreciate that very much. And to all who are taking time out of their day to view this presentation in real time, I also appreciate that too. I know your day is busy and your time is valuable. We're going to be talking about liquidity here and how liquidity matters and why liquidity matters. Most people would, from economics classes or business classes, understand that there needs to be a demand on one side to offset supply, and demand is essentially what liquidity influences. And in other words, if you have a product and you have buyers for it that have money, well, they're going to be able to buy that product, and depending on how much product there is, prices fluctuate as well as this liquidity picture comes into play in traditional scenarios. Right? But this also matters to the broader economy in the longer term cycles of the stock market. Liquidity matters to short-term cycles, yeah, but longer-term cycles are actually defined by natural liquidity levels, and we're going to talk about those here. However, I want to preempt the presentation with this. This presentation isn't telling you what you should be doing immediately in the stock market, right? It tells you instead where your mind should be relative to the changes in liquidity that are taking place. If you're looking for something that provides, say, actionable ideas, I did a webinar for Interactive Brokers at the beginning of May that maybe Cynthia has a copy of, and maybe she'll send out to everybody after this is done. If not, I can tell you where to get it. But that webinar talked about doji patterns, and there were strong reversal doji patterns at the top of the market in early May that were quite profitable if you took advantage of them, either by protecting portfolios or even shorting the market. But this presentation isn't about opportunities like that. This presentation is about mindset, and it is very broad and global because the liquidity influences are global. So let's take a look at those. So liquidity, what does it influence? It influences demand for assets. Think about how much money is out there available to be invested in asset classes like housing and the stock market and bonds. And you'll get an idea of my angle in observing liquidity. I want to know how much money is out there chasing these assets, because if I can determine how much money is chasing the assets, I can determine, with a degree of confidence, whether or not demand is going to be higher or lower than where it's been before. And demand plays a significant role in determining price. And with that, though, there is some skew in these variables, in these asset classes. The bond market, for example, can be a haven for people that are looking for safety. We've seen that recently, right? Over the past few days, especially, the bond market has been the flight to safety choice at the expense of the stock market. That doesn't necessarily mean that there's more money sloshing around, right? That's not what it means. But what I'm trying to point out by identifying this differentiation is that although we are, and I'll show you how, going to be able to determine how liquidity changes over time, we're not exactly sure of where the liquidity that still exists will be focused. So that's important, right? We're talking about liquidity that's available to be invested in all of these asset classes, not just one. And private business should be included here too, right? So this again is a broad observation of liquidity, but because liquidity influences all of it, it really matters to the overall observation. What you'll see as we come to a conclusion is that we're actually in a crisis of liquidity right now. This exists, and I'm going to prove it to you. It's not easy to see unless you're looking closely, but once you do, I think you'll agree with me. First, let's define the sources of liquidity. There are two of them. First, the people. The way we invest our money over the course of our lives, not the way we spend it, but the way that we invest money over the course of our lives plays a tremendous role in the liquidity that's available to be invested in the asset classes mentioned in the previous slide. We matter as a population. And in fact, that's where the natural component of liquidity comes from. But then there's a second source. The second source of liquidity was not even heard of before stimulus began, but it's central banks. The central banks play a significant role in liquidity for these asset classes because of their stimulus program. The FOMC, of course, as I highlighted here in this slide, but the ECB as well played a huge role in liquidity on a global basis. The ECB, in fact, bought assets directly that influenced the stock market to go up directly. And I'll explain that as I move forward. But the ECB and the FOMC combine to produce what I consider to be fabricated demand for these asset classes. This is a timeline of what happened for stimulus, right? Beginning in 2011 to 2012, we first got our notion of stimulus. In 2016, when the ECB decided to start buying corporate bonds directly, it had a direct influence on the stock market as well. But there was also a transition in that 2015 to 2016 period that we're going to look at. That's when there was actually no stimulus for a very short period of time. There are direct correlations between then and 2018 and 2019. You're going to see what those are. But the most important thing is that slowly but surely, this stimulus program, the amount of new demand that was stimulating the economy began to taper off. But as that stimulus program continued, as it pressed forward, as the ECB took the reins from the FOMC, three major bubbles started to be created, in my opinion. And those bubbles are the Treasury bond market, the bond market in general, the housing market, and the stock market. The problem here, though, is that it's very hard to quantify valuation in the bond market, and it's very hard to quantify valuation in the housing market versus the ease of quantifying valuation in the stock market. In the stock market, we can look at PE multiples and growth rates, and we can identify whether or not there is value in that investment in a more quantifiable method. And that's where my business is focused, of course, in the stock market. This is a chart of what happened since stimulus was introduced by the FOMC. Yes, straight up virtually, right? But not during that 2015 to 2016 period. This is when the baton was handed off from the FOMC to the ECB, right? This is the time when there was actually no stimulus for 1 month. I know that sounds crazy, right? There was no stimulus for 1 month, but the end of stimulus had come. Then the announcement that stimulus would come happened by the ECB, by the new stimulus would come from the ECB, and the market had all kinds of gyrations. But once the ECB announced that it was going to start buying corporate bonds directly, the stock market shot straight up. That's because investors now had a decision to make. Investors that owned those corporate bonds, I'm talking about large pension plans and hedge funds and mutual funds that owned a lot, millions of dollars worth of bonds. But once they get those bonds redeemed by a purchase from the ECB, they have to decide what to do with the money. Their decision is, one, should I buy the 3% or 4% bond again that I just sold, or something equivalent, or should I go into the equity market with some of that money and get the dividend plus growth that's afforded to me in the stock market? It's a logical transition. Some of that money went to the equity market to receive the dividend plus growth versus the bond market, which had ultra low yields. Needless to say, the market went straight up during stimulus with a slight pause in that 2015-2016 timeframe when the baton was passed from the FOMC to the ECB. And in the process, the S&P 500 increased to a valuation of 25 times earnings. But that stimulus that was pushing this market up and up and up doesn't exist anymore. As of 2019, stimulus is over, and there is a massive drain on liquidity, as you will see. This is it specifically. This is a combination of FOMC plus ECB stimulus efforts over time since the first quarter of 2017, actually. By the way, 2017 was a straight up market, and it was straight up because there was a consistent flow of money coming into the market every single month. 60 billion, 60 billion, 60 billion every single month during almost the entire year, save the last quarter of the year. But as that continued, as 2017 came to an end, even though the market went straight up, we started to get stimulus cuts. And slowly, in the middle of 2018, stimulus actually turned negative. Let's look at that a little bit closely. This is the timeline we were talking about. Stimulus is positive, 60 billion, 60 billion, 60 billion, and then it starts to taper off because the FOMC and ECB start cutting back on their program, and down and down and down and down and down stimulus goes. Stimulus is negative $150 billion a month right now, whereas before it was 60. So consider that 2.5 times more drain on liquidity than we saw during 2017 when the market went straight up. That's huge. And most of it is coming from the FOMC. Yes, the ECB is no longer buying new bonds, right? So they're no longer investing new money into bonds. So they're at zero now. But at the same time, the FOMC started draining liquidity by not reinvesting its principal and interest, slowly but surely, and now it's at negative 150. So the combined effort is negative 150. That's a big deal. That's a drain on liquidity. That's a threat to these bubbles if there's actually bubbles in the market. So let's look for some evidence. Let's look for some correlations to see what's the same or what's different in these environments. I can tell you this, 2018 had volatility again, and in a big way. That looked just like 2015. And we're seeing volatility now again in 2019 as well, right? We already saw a bunch of it the last couple of days. But 2018 to 2015, there's evidence that stimulus isn't there anymore. And so this is a matter of fact, right? This evidence tells us that there's direct similarities. And if that's true, there is a global liquidity drain that's happening right now that effectively makes the infusions that central banks made before old money. And this can have a material impact on stocks, bonds, and real estate. And then that leads to a question that's very, very important, I think, is that if this consistent inflow of money that was getting pushed into assets, bonds, stocks, real estate over the course of stimulus indeed pushed all the asset classes up and prices higher and higher and higher, will a drain on liquidity or lower demand levels influence those same asset prices down? That's important. My opinion is liquidity impacts all assets. It's a natural factor, supply and demand. And so, yes, this changed liquidity can influence stocks, bonds, real estate, private equity, private businesses, the demand for those assets. But that only matters really, right, if there is an excess valuation. Let's talk about that next. This is an article I wrote for MarketWatch. It says, don't be a bull in headlights. S&P 500's at 25 times earnings. I'm telling people, don't be blind to the risk, given the changes that are happening in liquidity. And there's a reason. And the reason is because there has never in the history of the stock market been a more expensive bull market than the one that we have just come out of. Some say we're still in it because we made new highs in the NASDAQ 100 this year. But assuming that 2018 was the end of the bull market at some point, there's never been a more expensive bull market in history than what we have seen recently. There have been more expensive markets, but those have only been during recessions, not during bull market environments. So in this particular instance, we're looking at one of the most expensive bull markets ever. That alone tells you that we're rich, that we're expensive. The divergence in the S&P 500's PE and its median PE over time is huge. And during stimulus, especially during the ECB direct bond buying program, the PE multiple went from 15 to 25 times earnings in the S&P 500. That's huge. That's a big move. And the market is expensive, with its historical norm being under 15 times earnings. That's historical norm for valuation. So 25 times earnings, that's expensive. But the ECB isn't the only source of liquidity. The second source of liquidity, of course, is the people, the natural source. And in fact, it's my opinion that the economy, the study of economics, is a study about people. It's all about people because we matter most. To varying economic data that we may get from time to time, our spending habits matter. But to long-term market cycles and economic cycles, it's our investing practices as a population that matter most. And that is exactly what the investment rate measures. The investment rate measures the rate of change in the amount of new money that's available to be invested into the United States, into all asset classes, annually, dating back to 1900, and it extends out past 2060. We can look ahead using this investment rate model to determine where demand is going to be years out. It's important. It's a proprietary macroeconomic analysis that I created back in 2002. And it's identified all major market cycles perfectly, with the exception of stimulus. However, it hit the 2007, late 2007, 2008 top in the market on the head. Think about it this way. This is the chart of the investment rate, right? The investment rate shows us more and more and more money coming into the market leading up to December of 2028. But between 2028 and 2038, otherwise known as the Great Depression, there were fewer dollars available to be invested into the US economy. Stock markets were tough. It's tough to build on the stock market. It was under pressure. The economy under tremendous pressure during the Great Depression. 1928 to 1938 was a down cycle in the investment rate. So was 1969 to 1981, otherwise known as stagflation. Fewer new dollars available. By the way, in between, more dollars available to be invested. Easy to grow. During down cycles in the investment rate, when there's fewer dollars to be reinvested, harder to grow. More trouble for the economy. More pressure on asset classes. Well, December 2007 marked the beginning of the third major down period in U.S. history based on this derivative demographic analysis, the investment rate. And it started that way. It got hammered until the stimulus money started to flow. And those propped up the demand side that would otherwise be deteriorating because of this natural phenomenon. Let's define this a little bit more. The investment rate measures the amount of new money because new money matters most. The money that's already invested into the stock market, for example, cannot be sold from one stock to buy another and just churned to expect the asset class to grow. There has to be new money invested for that to happen. So new money matters most. And we can't churn old money to make prices increase. This is extremely important for a number of reasons, but also think about this. If you ever wanted to take old money out, it could actually hurt the market, right? By creating more on the sell side of the market. So old money can't actually benefit asset price appreciation. It can only hurt asset price appreciation. And when we look at natural cycles, we can determine something else. We can determine when we look at natural cycles what the offset of the fabricated demand was as well. What's the difference? If we look where natural demand is and we compare it to where the demand is now with stimulus involved, because stimulus is really still involved, the multiples are still high. They haven't come down enough and stayed down enough to rebalance themselves. So we're still at these high multiples. And it matters. And it matters because the investment rate influencing the amount of money for investments and influencing therefore the demand for investments and therefore the stock market and the economy ultimately matters to the real estate we own, the 401k that we have, our retirement plans, our managed accounts, our mutual funds, our stocks, and our businesses. The amount of liquidity matters. And so the investment rate matters. And the difference in demand between where the investment rate says we should be and where demand actually appears to be given stimulus is about 66%. Keep in mind, the investment rate isn't telling us that there's not going to be any demand. It's telling us that demand on a natural basis is lower. So if there was $100 billion of new demand in year one, maybe there's 90 and 80 and 70 and 60 as year 2, 3, 4, 5 come, right? So there's less and less demand as opposed to 100 to 110, 120, 130. It's much easier to grow, especially see asset price appreciation in the 110, 120, 130 scenario versus the 190, 80 scenario. That's the difference. That's what the investment rate is telling us. And it's telling us that demand levels have shrunk since December of 2007, since the beginning of this third major down period, but at the same time, stimulus measures took off. The difference is 66%. My concern is, and this is where the liquidity picture comes back into play, the liquidity crisis picture come back into play, is that if demand reverts back down to natural demand levels, what's going to happen to the stock market? That's that crisis in liquidity. If demand is lower on a natural basis, as defined by the investment rates, which had never been wrong before about longer-term stock market or economic cycles, and which had identified the top in December of 2007 perfectly as well. The only distortion was stimulus, and we've quantified that and understand it as being another source of demand. And now stimulus is also negative $150 billion a month. We're looking at a massive drain on liquidity from the fabricated side and a natural drain on liquidity from the investment rate side, from the natural side. And that's a big deal. That can allow this market to fall aggressively once it finds a reason. And we all know that markets need a reason to move down, right? They just don't fall for no reason. But a reason could be a growing concern about valuation. Simple, right? The market is still expensive, and these demand side equations, these demand side variables are declining in a big way. In addition, You know, this corporate buybacks that was happening at the end of last year are no longer happening like they were. I mean, we can see tech stocks now getting slammed. And people can get caught in this liquidity drain if they're not careful. So be careful. There's the mindset, right? The mindset is you need to be protecting your assets in environments like this. It's extremely important because it's here. It's not like it's coming. It is actually here. And it's already started. We've already seen it in 2018, big declines in the market. We've seen a big recent decline too, but the markets are still generally up this year. So there's less concern. I would argue, by the way, that this year the markets are up because Trump's been dangling a carrot about China in front of the market, and people have just been buying it in hopes that there's going to be a deal. But I think that's more of a hopeful trade. That's basically what that was. That's kept sellers at bay, though. And that's all it takes. All it takes for asset appreciation is a marginal change in the supply and demand equation for stocks. And so far, there haven't been enough sellers to offset the lower demand that we're already seeing until recently, right? We did see that recently in the past few days, but not this year as a whole yet. My warning is it can come and you need to be ready for it, and markets are expensive. So you should be protecting around now. So I'll give you a bit of free advice. This is for your 401k, that account that you can't really do anything about, right? You can't trade it. There's no way to trade a 401k unless your employer is extremely flexible. But most 401k plans give you an option to trade once a month. You could buy or sell or whatever you want to do once a month, right? My recommendation to you is sell it all. That doesn't mean take your money out of the 401k. That means move it all into a money market account that pays you a whopping 1% or 2% in interest, and be happy with the massive gains you've probably gotten over the past few years since stimulus was enacted. Be happy that you're taking profits, if you will, at 25 times earnings or so in the S&P 500, because that's darn good. Don't be greedy. Protect that money because it matters to your retirement. That's the free advice I'll be giving you. My opinion is that yes, lower demand levels will influence prices lower, and it's just a matter of time. And everything will be hit, with the exception maybe of the Treasury bond market. Corporate bonds, yes, absolutely. They will be hit. But the Treasury bond market's a flight to safety. So interestingly enough, the Treasury bond market may actually find more demand as it drains demand from other asset classes. So keep that one in mind. Regardless of what it is, you're going to find liquidity to be an extremely important influencer of price. By the way, I'm concluding the webinar now and just discussing generally some information about liquidity. So if you have questions, please make sure to type them in the questions box. But the influence of the investment rate is extremely important, and you can find information about that on Stock Traders Daily. The investment rate tells you where longer term demand levels are and how they change and what they're going to look like 5 years from now and 10 years from now. And that can help you in your role, if it is simply to manage your own assets or to help a foundation that you're part of, or a business that you're part of. Plan for longer term economic conditions. The investment rate is extremely important for that. And you can find more information about it on Stock Traders Daily. And I'll also point out another place you could do that specifically. By the way, this is it in Stock Traders Daily. The investment rate talks about it, shows the chart and how to use it. But in addition to that, there are liquidity reports that are very important. And the most recent liquidity report that I wrote was back in August, as this drain finalized by the central banks. And if you're interested in seeing that, let me know, and I'll make sure you'll have my email when we're finished with this, and I'll make sure to get that to you, because that's very, very important. And that encapsulates what we've been talking about here, right? Also, I could probably give you that Doji webinar from the top of the market in early May too, if you're interested. I'll revert to the questions now and see if there's any questions from anybody. Bear with me for 1 second.
At this point, Tom, I'd like to remind everyone that if you do have a question, notice on the right-hand side of your screen, you've got a control panel. Double-click that questions title bar where you can enter any questions you might have for Tom at this point.
Avni asks, how big is the QE and ECB buy bubble? So during 2017 might be a good year to try to answer that question by looking at 2017. So in 2017, we had a purchase program that equated to $60 billion in capital infusions on a monthly basis, right? So every single month there was $60 billion more available to be invested into these asset classes than there was before. And that's important, right? Because that influences them. But where do they come from? Where do they go? Sorry, where'd that money go? Initially, all that money goes to bonds. But when they buy bonds, when these ECB, FOMC programs buy bonds, they're buying them from institutions who then have to reinvest those monies somehow. And part of those monies go into various asset classes, not all directly back into bonds. So $60 billion a month during the entire year of 2017 virtually caused it to move up, the market to move up almost in a straight line. Now they've reversed that, right? And instead of adding 60 billion, they're taking away 150. So it's huge. Avni, you're asking, so was it never bigger before? Yes, it was bigger before. So that monthly infusion during 2017 was actually $80 billion when it was first started by the FOMC. And so the monthly infusions were bigger when the FOMC was engaged, which is prior to 2015, 2014, right? So between 2012 and 2014, the ECB was being more aggressive than the ECB. However, keep in mind that the ECB made a decision in 2016, 2015 that really put it over and beyond the ECB's influence, and that was the corporate buyback, right? So the direct purchase of corporate bonds versus sovereign wealth, sovereign debt, right? The direct purchase of corporate bonds really matters because it went directly into the stock market in many cases. So so that mattered a bunch. So although the ECB did it at a lower pace than the FOMC did, it was much more direct than the FOMC bond buying endeavor. I hope that answers some questions about that. Thanks, Ivani. Rodrigo, why don't we short the market? So Rodrigo, we were short the market, not anymore, but we were short the market until yesterday, or excuse me, until the day before yesterday. We were short the market, and we made quite a bit. We're now long the market. I don't know where the things are, but we just made quite a bit. I think we made 1% between yesterday and today, or 1 to 2% between yesterday and today. And so we trade this thing, absolutely. I don't know that shorting it blind is the way to ever go. So I'm not going to tell you to do that, not at all, but I'll tell you when there's times to short the market if you're interested in knowing that. And you got to go to Stock Traders Daily for that, and that's what I do. You can also, by the way, we have a program with Interactive Brokers where if you're interested in getting trading reports on our individual stocks, you can also get those. And in those, there's also a market analysis, right? So if you're looking for our market analysis and you'd like to get that and you want to get it for free, the Interactive Broker stock reports, which Cynthia, I think, will send after the webinars over today, will allow you to get first information on these stocks that you might own that you're interested in. But at the bottom of those reports also are market analysis if you're interested, and they're updated every day. So so you can keep tabs with that sort of stuff. I'm not giving recommendations in those, so don't get me wrong. Those aren't telling you that I think that we should take profits in a strategy. Right? That's not the notion of those. It's about specific stocks and where to buy and sell those, and it's about general market analysis at the bottom. But that should help you, right? So look at that, because you'll get an idea when you read that market analysis section if the market is closer to a level of resistance than support. And really, Rodrigo, if you're looking at shorting the market, you want to do that when the market is at a relative level of resistance, right? And then you want to buy it when it's at a relative level of support. And that's exactly what we did recently with some of our strategies. Okay, I'm not seeing any other questions. I do appreciate the few that come through. I will leave this this webinar with this point. And again, if you have a question, type it in and I'll answer it before I leave, of course. But this is a mindset, right? The mindset is the risks are different. This is not 2017. This is not 2016 even, right? This is a new environment. That's actually an old environment because this is the way the market was before. Before stimulus, the market had volatility on a regular basis. Before stimulus, the market repriced itself when it was too valuable. But not during stimulus. It just got more and more expensive. Now people are trying to say that 25 times earnings is a deserved multiple for the market. That's never been true before. Could it be a complete shift in regime? It could be. I'm not here to tell you that it will or will not be. What I'm telling you, though, is that you do have a choice, right? You have a choice to adapt strategies that are more proactive in nature, that have embedded risk controls, and there is no smarter time, in my opinion, to do that than right now because of the shifts that we're seeing in the market right now. Take that 401k, move it to cash. That's a no-brainer to me, right? From there, use strategies that can make money no matter where the market goes, because that's the best way to do it from here. Joe, regarding the recorded version of this webinar, I am not sure where it's going to be, but I am sure that Cynthia will be sending you a link to it once it's up and available for viewing. Okay, thanks very much, everybody. I appreciate your time again today, and I hope that this can help you understand why you really do need to manage risk in this environment. It's extremely important. Thanks so much.
Well, Tom, thank you very much. And before you, everyone does leave, what I am going to do is grab the controls from you for a moment, and I do want to show you where you'll be able to find the Stock Trader Daily information. It's available to all interactive brokers for no additional charge. Now, you'll notice here, and let me make sure that I am showing you my screen. Okay, so you see that I have pulled up the Trader Workstation. Now, well, first of all, from here, what I'd like to do is let's bring the website up, and I'm going to go into the pricing menu on the Interactive Broker website. You can locate some additional information under Research News, Research and News. Now, notice at the top of the screen, we've got some jump links here, but I did want to show you that there's multiple information that's available. And if you're looking for Stock Trader Daily, you'll find that under the free services. Now, once you do go in here, notice I'm going to scroll down. These are listed alphabetically, by the way, and you'll find that Stock Traders Daily is included on this page here. There is a brief description, and you can learn more by simply clicking through this particular link. Now, notice here, this is a site that's devoted to Stock Traders Daily. Now, this will give you information about those reports that Tom was talking about, but let me also get back into our website. Once again, I'm going to pull up the website. Well, actually, I can go from right here because I did want you to see that underneath the education menu, you can find today's recording. This is where today's recording will be posted underneath the webinars. Now, as you go through here, you'll see our upcoming webinars are listed, but if you want to review any of the recordings, notice simply go into that recording link. This takes you to a page where all of our webinars are available. Notice here we've got multiple pages, so you can use the search field at the top of this screen to either go through Stock Trader Daily, either locate by sponsor or by presenter. And I do want to show you, as Tom was mentioning today, you'll see that just a few weeks ago, we did another webinar on how to identify and confirm a doji pattern. Now, today's event will also be posted here. And I do want to point out that the webinar notes at the link over on the right-hand side of the screen will take you into the slides that were used for today's session. This is the previous one here. But if you do want to come out, these are all available on demand. Now, also do want you to be aware that I have been recording today's event, and each of you will get a direct link to today's recorded playback soon after the session ends. So you'll get direct access to our recorded playback, as well as the same webinar slides that Tom has been using for today's event. So did want you to be aware of that. So if you want to review, and by the way, any of these recordings are available on demand. Simply click that link. There may be a small registration form that you'll need to fill out, but once you do, it will take you directly into today's recorded playback. So with that, we are going to conclude our session today. And like Tom, I want to thank all of you for spending part of your day with us here this afternoon. You can exit today's session using the X in the upper right-hand corner of the screen, and watch your inbox later on today if you do want to come back and review any of the concepts that Tom did discuss. So with that, I want to wish all of you a great rest of your day. Thanks for joining us here this afternoon, and have a great one. Thank you.